The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor of Subprime Auto Finance News and Auto Fin Journal. In today's webinar, the Repo Paradox, Challenges for Auto Lenders in 2019 and Beyond, we're going to learn more from Marina Hardy and Rick Vanco from Wolters Kluwer Lien Solutions. But before we get started, I want to go over a few housekeeping items for today's webinar. Please make sure you dialed in using the phone number provided in your communication email, or you're able to listen via your PC speakers. We are recording today's webinar, and we'll make the recording available to you as soon as possible. You will be in listen-only mode for this webinar, but we will reserve some time after the presentation for a Q&A session. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question today, don't worry, because we'll forward it on to the team at Wolters Kluwer Lien Solutions so they can respond back to you directly via email. And lastly, if you have any difficulty during today's webinar, please click on the hand icon to alert a member of our team. So with plenty of knowledge and recommendations to share, let's get right to Marina and Rick for today's webinar. The floor is now yours.
Thank you, Nick. And good afternoon, everybody. We really appreciate your time today, and we will take you through what we think the repo paradox is. I'll kick us off with the agenda. We'll take a look at the economy and some of the economic trends that we see that are impacting the repossessions today. We're going to talk about disruptions in auto lending space. We'll talk about the paradox itself in the auto lending market, and we will discuss what that means for lenders. We will close out by giving kind of our suggestions and advice on the steps that lenders should consider today to minimize their risk, maximize their efficiency. We'll start with the economy. And the economy, of course, is humming. And despite concerns about tariffs and sometimes consumers having less confidence and buying power, the numbers that we have seen were unprecedentedly healthy. We saw the GDP growing by 3%. We saw that in 2018, the growth continues. We know that in 2018, it was largely fueled by tax refunds, and so consumer confidence went up. We also know that the Feds raised their rates 4 times in 2018. Economy is still growing. We look at consumer confidence index, and while it was up and down, it's been up in the spring going into the summer. We look at very healthy unemployment rates, which I think at 3.5%, it was the lowest in 50 years. And we also know that the underemployment rate is down. And that, coupled with consumer confidence numbers, we see subprime lending in 2018 doubling in growth. And we see an interesting trend of more used vehicles being purchased, especially in the subprime space. So economy is doing really, really well. More people are driving cars. There are 281 million registered vehicles in 2018 on the road, which is a year-over-year growth and increase over the last few years. We see ride sharing continue to rise in Uber and Lyft and Car2Go. And we also see that there are many more buying and financing options. And here are just kind of a few that we listed. There are new ways to buy online through online marketplaces where you don't have to go the older route of going to the dealership. There are also new ways to borrow for dealers and for lenders. Lightstreams and AutoFi and AutoGravity, those online platforms connect dealers and lenders And of course, we see a lot of P2P borrowing where borrowers get to find lenders through platforms like Lending Club and Prosper. And so there are many more ways right now to not just finance a vehicle, to buy a vehicle, to use your vehicle, to own a vehicle. And all of this with a humming economy is very exciting for us because we know that the market is growing. These numbers are from last year, but auto lending is the fastest asset class with over $1 trillion in total balances as of the end of 2018. And what we also see is for consumer vehicles, over $500 million of new loan origination, which is the highest, I think, in the 19-year history of loan and lease origination data. So the numbers look really, really good and healthy. And yes, there is a paradox. And I want to hand off to Rick to talk about the contrarian auto lending market.
Thank you, Marina. So let's get into what is actually going on in the lending market. There's overextension on both sides, from the borrower and from the lender. As you can see here, 7% of all loans now are exceeding 84 months. There's actually some lenders that are actually having 108 months for their loans being extended because the price of the cars keep rising. Some other interesting facts here is the average loan amount has increased by 11% over the last 4 years. Previous years, we've never seen the average car price finance as high as it is today at 36, almost 37,000. The average car payment is moving upwards to, right now, the average car payment is about $547, but we see that continue to rise as more vehicles are being priced out higher. We've also seen borrowers moving more towards SUVs, trucks, with a lot of the luxury options as they're keeping the vehicles longer. The average monthly car payment is increasing. As you can see here, in 2009, it was $478. 2019 is $550. And it's not only the prime borrowers buying more cars, but non-prime interest rates are driving some of the monthly payments even higher. What does that mean? Delinquencies are actually growing. Recently on 60 Minutes, they did an interview with the head of the Federal Reserve Bank, who actually was talking about this same thing in delinquencies. You can see a record 7 million Americans are 3 months behind on their car payments, which is a red flag for the economy. One of the stats they used is an individual is more likely to miss a car payment than they will to miss a cell phone payment. If you think about that, that actually makes sense. Most of the folks today, their cell phone is their mechanism for everything, from social to business to paying their bills and so forth. So you can see why they would pay that versus making a car payment. And the lending is for repos. So if you think about this, 1.8 million units were repossessed in 2017. That was the highest volume since 2009. The volumes are growing due to an increase in subprime originations as well. Some prime borrowers are, on average, have a 14 to 20% interest rate versus the interest rate for prime borrowers, which is much lower. The delinquency rate for subprime is the highest it's been in the last 10 years. The last time it was this high was during the collapse of the industry with mortgage that affected the economy. We're starting to see the numbers reach those peaks again. It's the same old story. Auto lenders are issuing credit more freely, not only accepting lower credit scores, but also taking borrowers at their word regarding income rather than verifying it. There are now more subprime auto loan borrowers than ever before, and thus a larger group of borrowers at higher risk of delinquency. So you can see, if you think about trends in the economy, it seems to be bubbling up here to be at a stage where there is going to be some folks from the federal government getting involved here shortly if these trends continue to rise. Another noteworthy paradox, if you think about this, and when you think about this, and I was putting this together with Marina, and one of the things that jumped out to me is remote jobs, are more common, which is, you can work from home, you can sit there and basically do all your work from home, which means the need for a vehicle for a daily commute is dwindling. But you would think that would lead to lower volume in car sales, but this next piece is actually the reason why it's growing. People are getting new jobs in new markets. 10 years ago, you couldn't call Uber Eats or Grubhub and get things delivered. Groceries being delivered. So you can see that there is a lot of movement for individuals to own a car to add these services. Repos aside, this is the most alarming thing that we found. In 2014, delinquency rates on loans issued was about 2%. In 2019, it's now 5% and continuing to grow. What does that mean? That's $5 billion at risk today in this market. So what does this mean for the lenders? So let's talk about how this affects the lenders. First of all, we're getting lulled into a false sense of security by indicators of a good or even great economy, as Marina had mentioned. The financial climate is affecting the auto lending sector differently. Delinquencies are happening, and repos are as well. It's going to tax lenders' infrastructure and bottom line if this trend continues to go in growth mode. So what does this mean for lenders? When lenders have increase in repo, they have to add staff to support the increase. The increase in time, when we looked at this and we went back in, looked at years and talked to numerous customers, from the time they repossessed the vehicle till they sold the vehicle, on average was 40 days or less. In today's same space with the same lenders, the increase is happening. What are some of the drivers? Again, the higher volume being handled by the same staff. They're not adding additional staff to handle this. With all the changing regulations, there's more paperwork that has to be done, whether it's contacting a police agent in some states or filling out additional paperwork depending on the state. It is definitely regulations are changing. There's higher costs for the repo services. The person that used to do it before for $20 a day, over time with the economy growing, they need to make more money, they're raising their fees. The other piece that's driving this is the actual DMVs. Most of the DMVs are going through some modernization of their systems, which is even causing delays in issuing titles. So what's the risk to the portfolio for lenders? So increased volume of repossessions due to the increase in delinquencies. Repo means more administrative work. Anytime that the lender has to repo a vehicle, there are many steps that they have to take. They also have to stay on top of all of the jurisdictional changes with legislation. At least 25% of all the vehicle loans are going to show up on some type of exception report after 60 days. Most of those are showing up due to the fact that they weren't perfected quickly on the loan, which even adds more burden and complexity to getting a repo title or starting the process to move forward with the repossession. Added time, internal resources to handle this is definitely increasing. Using the repo affidavit with current title to supply to auction house is one way that lenders are doing this. Other lenders are going to one state and trying to do all their flips in the state to reduce time, but everything is constantly changing. Some of them are holding off on the repossessions until spring when they can get more value at the auction. So you can see there's definitely things that are changing. There's also the cost has gone up and time. So in this example, this is just an average based on a couple lenders we spoke to, that the repo man can average anywhere from $150 to $400 to do this. There's towing and storage fees, which for the most part, the storage fees are going to be by day. They're going to charge you. Flipping the title, which includes having administrative costs internally to do all the paperwork, do all the proper documentation in your system from an audit perspective, is taking time. The flipping title time, 3 days, 90 days, based on the jurisdiction, it's definitely changing. And these number of days are continually to change based on what the DMVs are doing with their system. How much volume are they having? DMV is not adding a lot of staff to handle this, so they're dealing with the volumes they were dealing with 5 years ago, which were minimal, to today, which are getting higher with the same staff. They're not adding additional staff to process this. What are lenders doing? They're getting creative now in how to get rid of a vehicle. So lenders are selling, to the market directly. There are a few lenders that actually put the cars on their lots and then advertise on the web that they have it there. They're using different platforms. They're not going through the traditional auction, but they're using different platforms to actually get rid of the vehicles. Lenders send assets to police auctions, not just lender auctions. So they're trying to get rid of vehicles quicker through various means. The auctions sell cars to used car dealer in certain states. Used car dealers, again, are bringing more volume in to sell more inventory. But again, most of the cars they're bringing in are going through a subprime borrower is going to wind up buying this with higher interest rates, which means it's going to keep going through this vicious little cycle. One stat we saw recently was there was this one vehicle that was purchased 8 times and repossessed 7 times within a year and a half from the same buy here, pay here dealership. They sold the vehicle, the interest rates were so high, they couldn't pay, they repoed the vehicle, put it back on the lot, sold it again. So 7 times they repoed it, and basically the vehicle was a very old vehicle that was being highly priced out, but you could see they kept bringing the vehicle back in and getting rid of it. The goal is to cover up repo costs and outstanding loan balances. Creative ways for lenders to dispose of repo cars, send out a list to repossess collateral to small business owners in the area. There's this new option that's happening is once they repossess the vehicle, they're renting out, especially when it's a truck. They're using some type of rental service on this. This one has been very interesting as it seems to be something new. There's not a lot of information about it. It's a very few lenders using this. So if you think about it, who really benefits from the repossession? The service industry has been experiencing a growth in the last few years. 3.6. Repo services are increasing, as I had stated before, with, what was $20 yesterday, is now $30, $35. The interesting thing is there is over 2.2 trillion daily turnover in the repo market, meaning the amount of money that's being spent on repossessions. Other challenges, legislation is constantly changing, giving the borrower more rights. The legislation is basically saying you need to go through every last resort to make sure that the borrower can pay this back without repossessing the vehicle. Legislation is changing to allow lenders to be more cost effective and reduce the amount of paperwork for repossessions. But in other cases, they're increasing the amount of paperwork. So it's going both ways depending on the jurisdiction. Compliance requirements are changing with legislation, considering the rights of the borrowers. Additional liens against the vehicles need to be paid. When you have the DMV now is attaching these additional liens to the vehicles, and when you go to flip it into the repossession title, they're wanting to collect on these fees. If they're not doing that, and basically you're selling a vehicle to auction with just the affidavit, whoever is taking that vehicle in certain jurisdictions and titling it is now going to be responsible for some of these fees, because they go to the same state that vehicle came from. They are subject to pay this based on the VIN and being titled within that jurisdiction. So you can see there's a lot going on. And here's just a few examples of some legislation. In Florida, any additional fees associated with vessels or vehicles, secondary lien by repair shops, must be paid. They're saying that they want to get paid before you transfer the title to any new owner. In Texas, a lender who repossesses a motor vehicle after a fault under a loan, lease, or other agreement, and who sells the vehicle to secure repayment of the debt, is not entitled to collect from the borrower any amount for a deficiency balancing resulting from the sale if the value is less than $2,000. This will be effective in Texas as of September of this year. Now, here's one for the lenders. Nebraska is stating a lender will no longer have to obtain a paper title prior to making application for repossession title. The output, I'm going to turn this over to Marina.
Well, thanks, Rick. And what does it really mean? So some of the trends, some of the thoughts that you can be seeing this, what would you do? What would a lender do today? We tell our customers, and we want to share with you kind of three key things. Stay educated, just like Rick said, staying on top of changing legislation and changing the updates to the rules and regulations. It's not just the fees, but it's also how we handle repo titles and how do we handle repossessions as you handle them as lenders. Understand those jurisdictional requirements and changes, and then get educated on those DMV rules and requirements. We hear from our customers, we hear from lenders how critical cost management and cost reductions are. This is a clear message. This is in all kind of the budgeting outlook to be, concise and precise around their messaging. Automation is key. Having the right tools to automate the front end and the back end and the internal processes. We urge you to consider value of APIs and integrate the tools that you're using today, the solutions that you're using today, to just remove the friction between them, seamlessly have them talk to each other and have the data flow. This will eliminate a lot of your manual in-house processes for repo title request management, but also will eliminate some of the errors that sometimes happens when two systems do not talk to each other, or not automated, or manual rekeying. We see a lot of that, and it's the cost of a fee sometimes, and sometimes it's the cost of the vehicle. And of course, optimizing those workflows. If something is or worked yesterday, consider looking and reviewing your workflows. What can you optimize? What can you automate? There are many partners in the industry who handle and who can help you. Of course, we do repossession titling too, as well as end-to-end titling. Whoever you work with, consider working with an expert who is staying on top of those jurisdictional requirements, who understands how DMVs work and what the latest legislation is. Working with a vendor sometimes is better because you can get predictable fees, going back to those cost structure constraints. We know that a lot of vendors will help you improve turnaround times for your repo titles, and part of it is automation, and part of it is relationships in the business that we're in. Visibility and ability to audit your auto lending portfolio is important. So when you are partnering and you're implementing a new tool, consider the ability to view or track the status of your repossessions from start to finish. And as Rick said, repos on the rise. There might be higher volumes. We talked about economy healthy, but then tariffs and other considerations right now that doesn't make it predictably healthy going forward. Can you, with the resources you have today or with a vendor you have today, can you have those increased volumes that are possibly coming your way? So here are just kind of a few things to think about. Rick, any parting words before we go into questions?
No, Marina, you did an awesome job in explaining that. Thank you very much.
You can always learn more about what we do. You can also email us directly. These are real names and real email addresses. We would love to take some questions.
Excellent presentation. Thank you so much, Marina and Rick, for the great information that you've shared today during our webinar. The repo paradox, challenges for auto lenders in 2019 and beyond. And if you have questions for Rick or Marina, please use the questions box on the GoToWebinar control panel, and we'll try to get to a couple here during our time remaining. And one of the first questions to come in, Marina and Rick, would love to get your thoughts on this question, stemming from some of the economic trends that you had shared, coupled with the delinquency and other metrics that you shared as well. The term bubble came up again. So it was certainly a term bandied about here in the past few years. Just each of your thoughts. Are we heading close to another bubble in the auto finance space? Just what are your thoughts there?
So our thoughts on that is, if you look at some of the drivers that caused the financial crisis back in 2007, 2008, most of that was driven by some of the same things we're seeing here, where they're extending credit to people that should not be having credit limits of so high. Number of defaults with home loans were causing a lot of foreclosures to happen. So the bubble burst. We're not saying that it's going to burst here. We do know that, again, the Federal Reserve is definitely keeping an eye on this, and you're starting to see more rules and regulations get passed down from CFPB in regards to motor vehicle lending. So you can see, we can't predict, but it does seem to be the same type of things. If you think about what you saw in the mortgage industry back then, there were a lot of companies popping up, refinance your house, refinance your house. We're starting to see that same trend in the motor vehicle space. There's all these new companies that are coming up out there that are soliciting borrowers to refinance their vehicle. It's just an indicator that there is a lot going on in this space, and something to definitely keep your eye on and your finger close to the pulse. As these continue to rise, there's definitely something is going to bust. Anything to add, Marina?
That's a good answer. I agree.
Thank you, Nick.
Again, the voices that you're hearing, that Rick Vanko and Marina Hardy, who are from Wolters Kluwer Lien Solutions, our special guest experts for today's webinar. The Repo Paradox, challenges for auto lenders in 2019 and beyond. And just as a reminder, we are recording today's webinar, so please keep a watch of your inbox for a link to that recording so you could review the great information and presentation that Rick and Marina have shared and distributed around your shop to be prepared in your repossession and recovery departments and to sharpen strategies there. And next question, again, kind of a forecasting inquiry. Whomever would like to tackle this challenge, so to speak, just what is your outlook for the future of repossessions? Up, down, staying flat? Just if you could, as much as you can, your thoughts on where repossessions might be trending in 2019 and beyond.
This is probably more of an educated guess, as we're all trying to guess where their economy is going to grow, given the tariffs, given what is happening in consumer confidence index and how consumers are going to be buying, right? So we know that while consumer confidence is up and down, we also know that in 2018, there was a little bit more of a disposable income for consumers because of the tax break or tax change or tax reforms. But we do not know if we'll be seeing similar numbers in 2019. What we do see is retailers not doing very well, and we could see consumers pulling back a little bit on discretionary spending. So with that, we can't predict, but we believe that repossession number is probably going to continue to grow. We also know from the consumption trends that consumers started getting into more luxury vehicles, and we know that sometimes it's a bit of a stretch for their income, and sometimes when the economy slows down or turns down, the expensive vehicles, the luxury pieces are the first to go. So that might mean actually more work for lenders in the repo market. Right?
I agree with you, Marina. If you think about it, anything happens in our economy and it starts trending downward, this number is only going to rise. So if you think about it, there is a 2.2 trillion daily turnover in the repo market. The U.S.-backed securities account for 48% of the total value in the daily turnover rate. So you can see that if anything happens in our economy and it starts trending downward, the number of repossessions is just going to rise. It's just a fact.
That's true. We also know that, more new car registrations, more than 107 million Americans have at least one car loan. It may not be as sustainable if the economy slows down. So our outlook is positive for the repos, would you say?
And to add to that, 6 million, if you think about that, Marina, about 6 million Americans with an active loan are 90 days or more behind on their car payments right now. That puts them in danger. That puts a lot of the lenders in danger as these trends continue. So you think about 107 million have a loan, 6 million of that are behind at least 90 days. Mm-hmm. So
we see higher delinquencies for sure, which lead to repossessions.
Very good. Again.
Thank you.
Oh, go ahead. Please continue. Sorry.
Rick and I will talk until you turn off our microphones. But we were thinking, and that's kind of going back to economy and economic outlook, but if you think about repossessions that occur in the subprime subprime loan industry with a higher interest rate, that once the repossessions happen, and if they do increase, it affects so many things, right? They can't buy another car. It affects their qualification for affordable housing. So it's kind of a little bit of a house of cards, and it's going back to that first question you asked us. But for us in the repo segment, it's actually not necessarily bad news. More work. Thank you, Nick.
Very well said. Again, the voices that you're hearing, that's our special guests for today's webinar from Wolters Kluwer Lien Solutions, Marina Hardy and Rick Vanko. For our session today, the repo paradox, challenges for auto lenders in 2019 and beyond. And just a reminder that we are recording today's session, so please keep a watch of your your inbox for a link to the recording so you can review the great materials that Rick and Marina have shared. And again, their website is there displayed on the screen, leansolutions.com/repo, and as well as their direct email addresses if you choose to send a message to either of our guests today to reach out with your specific questions and comments directly. And to wrap up our time today, Rick and Marina will kind of gather up a topic that's been raised by several attendees, and you mentioned it during your presentation, and it seemed to have struck a chord regarding the delays in titles from DMVs stemming from the various departments upgrading their systems, switching technology strategies. Again, what have you heard from the frustration level from clients, just how DMVs are striving to improve their systems? Just what are your perspectives there on the titling components as DMVs are going through kind of a metamorphosis nationwide?
Yeah, that's a great point, Nick. We're seeing it more and more. You know, most of these modernization projects that the DMVs are taking on right now, you know, you think about updating your internal systems, you know, you might have to wait 6 months to get an enhancement or something like that. On average, most of these are taking anywhere from 3 to 5 years to do the upgrades. They're spending a lot of money to do it. They're trying to tackle various sections. They're trying to first take care of the consumer. The consumer is what they're trying to do. They're offering more solutions that you can do yourself without actually having to go into DMV. But one of the ones that was most interesting lately was Minnesota. Minnesota, a few years ago, started a project with modernization. They spent a lot of money, and I think some of the stats said it was upwards close to $1 billion in modernizing their system. What happened? Anybody who was in Minnesota probably knows what happened. The system failed. They were unable to issue titles, you know, where they were issuing it previously within less than 30 days was taking 6 months or longer. If you got a car and had temp tags, you had to show a receipt that you actually went to DMV because tags and titles were not being issued along with registration. The state did allow, the legislation in the state of Minnesota allowed for more money to be pumped into it, and today it's back to normal. But these are some of the problems we're seeing when DMVs are hiring outside consultants to do the building of their systems without understanding their business. It's causing more delays from the titling aspect to getting tags to, you know, the time it's taking. Meaning, in some cases, when they do modernization, their systems are unavailable for the staff to use for certain periods of time throughout the day. So this trend is continuing. Right now, I would say there's probably about 15 states or more that are actively in this process of doing modernization projects. And you think about it, most of the DMVs, when you went into their offices, their systems were from the 70s and 80s. Well, they're bringing it to the 2000s, and then you know what's going to happen. The systems are going to become stagnant again if they don't continue to pump money into it, which means in the next few years, they're going to have to go through some new type of modernization to update their systems. Marina, anything to add?
No, very true. And I guess my only word of advice, if I may say so, work with somebody who's plugged in and connected and understand the jurisdictional needs and requirements so you're not caught off guard by the modernization and the changes that can affect your customers and your titles. So that's it.
Thank you, Marina.
Again, that's Marina Hardy and Rick Vanko from Wolters Kluwer Lean Solutions. Thank you so much for sharing the great information and industry perspective.
Thank you, Nick. Appreciate it. Thank you, everybody, for listening in.
And for all of us at Cherokee Media Group, I'm Nick Zulovich. We thank you for joining us, and we look forward to having you again next time.